Welcome to the deep dive. Today we're tackling the core of finance.
Yeah, looking at the fundamentals and really the growing role of quantitative methods.
We've got this really comprehensive source material here. Covers basically everything from, how institutions work all the way to AI and investing.
Right. And the goal, our mission really, is to pull out those key insights.
Connect them, give you a solid foundation, but without getting, too bogged down.
Exactly. Whether you're already in the field or just curious, we're aiming for those aha moments.
The moments where it just clicks.
Yeah. We'll hit the foundations, intermediaries like banks and insurance, trading, private markets.
Mortgages too. Financial crises, can't forget those.
Definitely not. Asset management, and then, yeah, the big one, the impact of AI.
Okay, let's unpack this. Our source starts right at the beginning, the foundations of modern finance.
At its core, finance is really about, decisions about money, managing it, assessing risk.
Creating value, essentially.
Yeah.
It underpins so much of the economy.
And right there in the center are these financial intermediaries.
Yeah, what's the core problem they solve? The source uses a good example.
Right. The computer seller and buyer, someone selling online, someone buying, maybe miles apart. They don't know each other.
So there's a trust issue.
Exactly. Seller ships, will they get paid? Buyer pays, will they get the computer?
And intermediaries, banks, payment processors, they step in.
Yeah, they act as that trusted third party, making sure the transaction happens safely for both sides.
Right. And the source breaks down the key types. Banks, obviously, are the classic example.
Taking deposits, making loans, but they're always managing risks.
Like credit risk. What if the borrower doesn't pay back?
And liquidity risk? What if too many depositors want their money at once?
It's a constant juggle.
Then you've got insurance companies.
Risk transfer, basically. You pay a premium.
And they cover you if something bad, something specific happens. The scale of risk they handle is huge.
And fraud is a big challenge for them.
Yeah, the source even mentions using things like satellite images or drones to check claims.
Wow, okay, so even traditional insurance is getting high-tech.
Absolutely. Then there are trading firms.
Providing the platforms, the infrastructure for buying and selling stocks, bonds.
Right. It used to be people shouting on a floor, which is hard to picture now.
Totally. Now it's all super fast, electronic, algorithmic trading.
That shift has been massive. Algorithms analyzing data, making trades faster than any human could.
Makes markets faster. Maybe cheaper in some ways.
But also adds new kinds of complexity, potential for big swings, especially when markets get stressed.
Definitely. And asset managers, we can't forget them.
Right, the firms managing portfolios for people, for institutions like pension funds.
And the source brings up that key idea. No free lunch.
Yeah, you generally don't get high returns without taking on more risk or, paying some costs.
Makes you think of Bernie Madoff, right?
Yeah, right.
Promise the impossible.
Exactly. High returns, no risk. Doesn't work. It was a Ponzi scheme, a cautionary tale.
And asset management is using more and more quantitative methods now.
Hugely reliant on it. Data scientists, analysts building models to predict markets, manage risk, shows the need for those analytical skills.
For sure. And lastly, clearinghouses. Kind of behind the scenes.
Very much so, but crucial. They ensure trades actually settle, especially in complex markets like options and futures.
So they manage the risk that one side might default on a trade.
Exactly. Credit risk, liquidity risk, operational risk.
Yeah.
There's central counterparties managing all that, keeping the system stable.
Okay, so across all these intermediaries, some basic principles emerge.
Yeah. The source hammers home, no risk, no reward. Higher potential return usually means higher potential loss.
And that no free lunch idea again. Like Warren Buffett focusing on value, not quick bucks.
Right. Careful analysis, finding undervalued assets.
And underpinning it all is quantifying risk and reward.
Increasingly so. Using data analysis to figure out asset values, loss probabilities, expected return.
Which is why STEM skills, science, tech, engineering, math, are just so vital now.
Couldn't agree more. And the technology impact is huge. That Philadelphia trader anecdote.
Right. The before and after. From gut feel.
To needing deep data insights. Really highlights the need for quantitative skills today.
Okay, let's maybe shift gears a bit and talk about banking foundations.
Sure. Banks are, as the source says, really central to the economy.
Taking idle money, deposits, and putting it to work through loans.
Which fuels growth, creates jobs. It's a core function.
So what are those core functions?
Well, first, collecting deposits, gathering funds.
Second, payment services, moving money around smoothly.
And third, loan underwriting. That's the crucial part of assessing if someone's likely to repay before lending them depositors' money.
And how do they profit? The interest rate spread is key, right?
Exactly. The example given is like they pay depositors 4%, charge borrowers 10%.
That 6% difference is their potential income. Before costs and risks, of course.
Right. Then there's reserve ratios and money creation, fractional reserve banking.
Meaning they don't have to keep all the deposits on hand?
Nope. They hold a fraction, a reserve, maybe 10% as an example. They lend out the rest.
And that lending creates more money in the system.
Yeah, it has a multiplier effect. It's a balance, though. Too much lending can cause inflation, too little slows growth.
And banks do more than just deposits and loans. Global markets divisions.
Trading securities, facilitating investments globally.
Advisory arms for M&A. Using big data now, apparently.
Oh, yeah. Things like satellite imagery to check retailer parking lots or social media sentiment analysis.
Interesting. And derivative trading, too.
Which can be speculative, but also really important for hedging risks, like changes in interest rates.
And there are different types of banks, not just one monolithic thing.
Right. Retail banks for individuals, wholesale or commercial for businesses, investment banks for capital markets.
Money center banks operating globally, regional, and local banks. Each has its niche.
And its own challenges. Credit risk, liquidity risk, we mentioned those.
The source also points out, for anyone listening who's interested in careers, that quantitative backgrounds are really in demand.
Especially in risk management and trading roles, definitely.
Okay, so moving on to managing these banks and understanding their financials.
The source calls them complex money machines, connecting savers and borrowers, but heavily regulated.
Makes sense. And they have a typical corporate structure board, CEO, CFO. CRO is key too, Chief Risk Officer.
Absolutely. And quantitative skills pop up everywhere. Even anti-money laundering uses stats models.
Even marketing is data-driven now.
For sure. Understanding the financials is key. The balance sheet.
Assets, liabilities, equity.
Yeah.
Shows their leverage, right? Banks tend to use a lot of debt relative to equity.
Exactly, which is why capital adequacy ratios are so important for regulators, making sure they have enough buffer.
And the income statement shows performance over time, interest income, expenses.
Net interest income, operating costs, provisions for loan losses, that spread we talked about is the core profit driver you see there.
Asset liability management, ALM, sounds crucial.
It is. The classic strategy is borrow short, lend long. Borrow via short-term deposits, lend via longer-term loans.
Profitable if long-term rates are higher than short-term rates, so an upward sloping yield curve.
Right. But it creates interest rate risk if rates move against you. ALM teams use tools like interest rate swaps to manage that.
And risk management is obviously huge. Interest rate, credit, liquidity.
Market risks from price changes, operational risks like fraud, reputational risk.
They use tools like value at risk, VAR, and stress tests.
Yeah, trying to estimate potential losses under bad scenarios.
What about off-balance sheet stuff? Derivatives.
Right. They don't always show up directly on the balance sheet, but can carry significant risk. Can be used for hedging, but also speculation.
So again, a massive need for quantitative analysis, evaluating models, predicting fluctuations, assessing default odds.
Absolutely central, which again points to career paths in quant trading, data-driven marketing, fintech roles within or around banks.
Okay, let's dive specifically into loans and credit risk now.
The source breaks down the basic loan terms. Borrower assessment, the amount, interest rate, maturity, repayment schedule.
Collateral, if any, and what triggers a default.
And credit risk is simply the risk the borrower won't meet those terms.
There are lots of loan types, right? Secured versus unsecured.
Funded loans versus unfunded lines of credit, consumer versus corporate loans, each with different risk profiles.
What's the difference between loans and bonds, fundamentally?
Loans are often direct agreements, maybe more customized. Bonds are securities, traded in markets, usually more liquid.
Bonds rely more on the issuer's general creditworthiness, less on specific collateral sometimes.
Often, yes. Investment banks play a big role in issuing bonds for companies.
Right. Investment banking focusing on those big, complex deals, raising capital, M&A, advice.
Sales and trading, research, asset management, it's a wide scope.
Now, predicting default risk and potential losses, that sounds like where data analytics really comes in.
Critically important. Banks are using statistical models, machine learning, AI to get more accurate predictions.
Not just for individual loans, but for managing the whole portfolio. Forecasting default rates, stress testing.
Exactly, and regulators demand a lot of this kind of analysis for compliance, too.
The source also mentions loss mitigation strategies, ways to help borrowers who get into trouble.
Right, and it introduces hazard rate models for understanding risk over time.
hazard rate HT2. So the probability of default right at a specific time, Tin?
Basically, yeah. It gives a more dynamic view of risk, more flexible than static probabilities.
But applying data science isn't perfect. There are pitfalls.
Definitely. Bias in the data is a huge concern, could lead to unfair discrimination.
And the black box problem with complex models, hard to know why they make a prediction.
Exactly. And the risk of self-reinforcing trends. The source really stresses needing models that are fair, interpretable, not just accurate.
So you need audits, governance around these models.
That's absolutely essential.
Okay, let's pivot to insurance fundamentals.
Core idea. Risk transfer for a premium. You pay, they take the risk.
And the concepts of survival probability and hazard rates come back here.
Yeah, very similar application as in credit risk. Think mortality tables for life insurance. It's all about probabilities over time.
And like banks, insurers are intermediaries. They collect premiums.
And invest them, trying to grow reserves to pay future claims.
So they're balancing pricing risk charging enough with investment risk.
Exactly. Plus regulatory rules. They make risk earnings if claims are lower than they priced for.
What's this parametric insurance the source mentions? Especially for climate risk.
It's interesting. Instead of paying based on assessed damage, it pays out when a specific event trigger happens.
Like a hurricane hitting Category 4 or rainfall below a certain level.
Precisely. Can be faster, simpler for large-scale events. Might link insurance more easily to capital markets.
Fraud is still a big issue, though.
Oh, yes. Technology and data analytics are key tools for detection now.
The main types are life and health and property and casualty.
Those are the big categories, yeah. And you have global players and more specialized firms.
Career-wise, actuaries are key, assessing and pricing risk.
Definitely. But also risk analysts, data scientists using quantitative skills.
All right, let's talk trading ecosystems and private markets now.
Investment banks and trading firms are central, advising on capital raising, M&A, plus sales, trading, research desks.
The source even gives some 2023 fee performance for the big global banks.
Yeah. Then you have proprietary or prop trading firms.
They trade with their own money, not for clients.
Exactly. And they tend to be heavily reliant on quant research and strategies.
Brokerages are the intermediaries here, earning commissions or spreads.
Right. And market microstructure gets into the nitty-gritty of how orders interact.
Like payment for order flow, PFOF. Brokers getting paid to send orders somewhere specific.
And market orders versus limit orders, how they affect the order book. High-frequency traders watch this stuff closely.
And the move to electronic and algorithmic trading has been huge.
Totally transformed things. Need for super low latency tech, machine learning models to find opportunities, execute trades.
Renaissance Technologies Medallion Fund is the famous example of algorithmic success.
Incredible performance, yeah. Then you have derivatives, futures, options.
Used for risk management, but also speculation, leverage.
Right. And clearing corporations are vital here, guaranteeing settlement, managing margin.
Hedge funds and alternative investments. Lots of strategies there.
Long, short equity, global macro, quant approaches. The 2 and 20 fee structure is common.
2% management fee, 20% of profit.
Typically, yeah. And they often use alternative, unconventional data sources.
Private equity is another big alternative area. Investing in private companies.
Blackstone, KKR, Carlyle are the big names. They do leveraged buyouts, provide growth capital.
Comes with risks, though, leverage, illiquidity.
For sure. Due diligence is key. And they're using more advanced analytics now, too, like tracking foot traffic data, geospatial intelligence.
For careers here, the source emphasizes internships, coursework, competitions, networking.
And knowing resources like the Green Book for interviews, it's competitive.
Okay, let's tackle mortgages and the U.S. housing market. Huge area.
Absolutely central to household finance. Trillions in real estate value, trillions in mortgage debt.
Lots of STEM jobs here, too. Banks, non-banks, GSEs, fintech.
Definitely. Mortgages matter for household wealth, largely through leverage.
Right. Small home price gains can mean big percentage returns on your down payment.
Plus tax advantages, refinancing options. The U.S. system is kind of unique.
How so?
Long-term fixed rates are common, relatively easy refinancing. Different from, say, Canada, where shorter terms are more typical.
Key concepts. Leverage, loan to value, LTV.
Right, comparing loan size to property value. Also, housing isn't really mark-to-market daily like stocks. No margin calls, usually.
Prepayment and refinancing dynamics are important, too. Borrowers can pay early or refi.
Which is good for borrowers, but adds complexity, prepayment risk for investors holding mortgage debt.
Why are mortgages attractive to investors, then?
Scale and liquidity, especially for agency-guaranteed debt. And the role of government-sponsored enterprises, Fannie Mae, Freddie Mac, Ginnie Mae.
They bundle mortgages into mortgage-backed securities, MBS.
Exactly. Channels global capital into U.S. housing. They provide a sort of backstop guarantee. Investors still face prepayment risk or extension risk, though.
The source touches on the math amortization schedules, how payments split between principal and interest.
Yeah, driven by principal, term, interest rate. And it looks back at history.
The housing boom, the great financial crisis, relaxed lending standards, subprime loans were a big part of that.
And the market keeps evolving. More non-bank lenders now, GSEs still crucial. Prepayment and refinancing risk remain key dynamics.
Okay, turning to financial crises and bank risk management, focus on commercial banks.
Their role as intermediaries for capital and credit. The source notes the number of banks, FDIC insurance.
Where are the most analytics jobs in banks now?
Model risk management, credit risk modeling, stress testing, and capital planning. Big demand for those skills.
The source talks about linear risk, expected loss, and CECL.
Right. CECL is the accounting standard, current expected credit losses. It's forward-looking, trying to estimate lifetime losses.
But then there's fat tail risk, black swan events.
Yeah, the idea that really extreme losses might be more likely than standard models predict. Correlations can spike unexpectedly in crises.
Basel Accords set capital requirements to handle this. Tier 1, Tier 2 capital.
Exactly. Basel II introduced risk weighting. Basel III added more buffers after the crisis, designed to absorb these bigger unexpected losses.
The source shows a hypothetical bank balance sheet. Again, assets, liabilities, capital, FDIC insurance on deposits.
Yeah.
The spread driving profit.
And uses Xerox as a case study for an individual loan loss impact of rating downgrade.
And that SunTrust example from 2004?
Yeah.
An Excel error in their loss allowance.
Yeah, highlights the need for controls, governance, led to a regulatory penalty. Simple errors can have big consequences.
Securitization comes up again, pooling assets like mortgages into MBS.
The selling eggs analogy, pooling loans and selling them off in different risk slices or tranches.
What about the Gaussian-Coppola model? It was used for correlation.
It was widely used to model default correlations before the crisis, but it failed badly. Didn't capture asymmetric tail dependence, the fact that things become much more correlated during extreme downturns. It assumed correlations were more stable.
So alternatives like Gumbel-Coppola are better. Caution needed with any model's assumptions.
Definitely. Banks use capital models, often Excel-based with Monte Carlo simulation, to figure out required capital based on these risks.
And that other SunTrust story, using appreciated Coca-Cola stock during the 2008 crisis.
Yeah, an innovative way to manage capital and liquidity when selling large blocks of stock directly would have been problematic. Showed creative thinking under pressure.
Okay, shifting focus again, this time to insurance, careers, and opportunities.
The actuarial path is a big one. Progression from ASA to FSA.
Associate to Fellow of the Society of Actuaries. Lots of exams, learning modules.
Rigorous process, yeah. Takes several years, typically. They're trained to estimate probabilities, apply risk pooling, manage liabilities.
Working in life health or property casualty. Companies often support this.
Big time. Study time, exam fees, rotations, salary bumps with exams. It's a well-structured path, can lead to leadership or specialized roles.
But insurance isn't just actuaries.
Not at all. Risk management, underwriting, finance, investment management, claims, sales, marketing, IT, data science, legal, compliance, lots of roles.
And these roles interact more now.
Increasingly so. Consulting is another option, varied projects, market entry, product development, regulation, M&A support.
Sounds intense, but good exposure.
Definitely. Fast-paced, broad skill development, high visibility.
The source revisits some key insurance concepts, too. Annuities and longevity risk.
Right. Different types, immediate, deferred, variable, indexed. Managing the risk people live longer than expected. Involves hedging, updating mortality tables.
Pension risk transfer, PRT. Companies offloading pension obligations to insurers.
Yeah, big business. Complex forecasting and hedging involved between quoting and the actual transfer.
And longevity swaps, hedging life expectancy risk while keeping the assets.
Exactly. Paying a fixed amount versus getting reimbursed for actual payouts needs sophisticated modeling.
Private equity is getting into owning insurers, too.
That's a growing trend, yeah.
So for breaking into insurance, what skills are needed?
Data and tech skills are huge. Programming Python, R, C#, SQL, big data platforms, predictive modeling, machine learning.
Visualization tools like Power BI, Tableau, financial engineering for hedging.
All of that. The source suggests specific projects students could do to build these skills.
Great. Okay, final big topic area, Asset management.
Revenue model is mostly fees on assets under management, AUM.
Clients are institutional pension funds, endowments, and retail individuals.
Right. Products and strategies have evolved a lot. Used to be more institutional, now huge retail presence via mutual funds, ETFs, target date funds.
You need good distribution channels, operational expertise.
Absolutely. Strategies vary too. Single asset like just stocks, or multi-asset like target date funds, or liability-driven investing, LDI.
LDI matches assets to future liabilities, like for pensions.
Exactly. And the source touches on retirement distribution complexities.
How people draw down savings. Potential role of annuities.
Yeah, behavioral issues too, people underspending or overspending. Annuities and 401ks are being discussed more, though there are pros and cons. Partial annuitization might be optimal for many.
Organizational functions. Manufacturing, research, trading, distribution, marketing, sales, control, legal, risk, compliance.
And fiduciary duty is paramount, acting in the client's best interest. Market timing scandals led to reforms there.
Active versus passive management is a huge debate.
Always. Passive has low fees, tracks an index closely. Active aims to outperform but costs more, and many don't consistently beat the market. Might work better in niche areas.
Long only versus long short strategies. Short selling adds complexity.
Definitely. Risks and potential benefits there. And ESG is increasingly important.
Environmental, social governance factors in investing.
Lots of career paths here too, often involving rotational programs to get broad exposure.
Okay, this brings us finally to AI in quantitative investing, history and future.
The source lays out the quant investment life cycle. Research, data processing, model training, portfolio construction, execution, risk management.
And AI is impacting all of those stages now.
Increasingly so. Feature engineering, portfolio optimization, risk management, automating trading.
What about new uses for large language models, LLMs?
Reviewing academic papers automatically, generating synthetic data for testing, creating smart surveys, processing text for sentiment analysis. Lots of potential.
Why the exponential growth of AI in quant finance?
The source points to 4 pillars. Math advances in AI, massive data availability, huge computing power growth, and now LLMs.
Let's look closer at the lifecycle components. Research.
LLMs automating literature reviews, helping prototype algorithms, even generating code.
Data processing. Handling unstructured data.
NLP for text, OCR for documents, object detection like YOLO for images. AI helps manage diverse data types.
Model training uses deep learning. CNNs, RNNs, transformers like ChatGPT.
All those architectures, yeah. JANs too. It's a rapidly evolving toolkit.
And portfolio construction, risk, execution.
AI for dynamic rebalancing, genetic algorithms for optimization, anomaly detection, reinforcement learning for trading strategies.
Well, so looking ahead, what's next for LLMs?
The source predicts more contextual understanding, dynamic embedding dimensions, personalized outputs, better multimodal analysis.
Macro-level reasoning. Automation at scale. Word embeddings get mentioned.
Yeah, representing words numerically to capture meaning, the tech keeps advancing.
And AI isn't just for quant finance.
Crucial point. Applications in healthcare, logistics, education, the skills are transferable. AI tools are becoming more accessible.
But understanding the tech and the ethics is critical.
Absolutely. Huge potential, but needs careful consideration.
So wrapping this deep dive up,
Yeah.
several interconnected themes really stand out.
Yeah, the foundational role of financial intermediaries, managing all sorts of risks.
The absolute necessity of understanding and quantifying that risk.
The increasing reliance on quantitative analysis and tech, especially AI, everywhere you look.
And, consequently, the diverse career paths for people with STEM skills in finance.
We really hope this journey through the material gave you some of those aha moments.
Yeah, hopefully a clearer, more solid foundation in these pretty vital areas. We definitely encourage you to think more about these ideas, maybe dig deeper into something that caught your interest.
Which leaves us with a final thought, maybe a provocative question for you to consider. How will AI's continued rapid evolution actually reshape those fundamental principles of risk and reward we've been talking about?
That's a big question. And what new kinds of financial intermediaries or even entirely new markets might pop up because of this tech transformation? Something to definitely keep an eye on.